10-year notes seeing better sellers as yields rise. Recall late last week we saw yields down around 260-ish. Now we're back north of 270, so a pretty big move in a very short amount of time. The market right now still adjusting to the post-FOMC announcement and press conference, still adjusting to the stronger than expected non-farm payroll number, and still adjusting as to what is to make of all the uncertainty, whether it be China trade talks, whether it be Brexits, whether it be U.S. Federal Reserve policy. There's a lot of what ifs out there, and the bond market right now has been pulled around in all directions. You know, the last one being here, the balance sheet withdrawal from the Federal Reserve. How aggressive are they going to be? They really haven't changed anything, but certainly looks like they may, and that would be bullish for bonds. But lo and behold, the data right now is winning the tug of war, and yields are creeping higher, although not high enough to get us through that threshold, that 275 threshold that we were straddling for so long. That's going to kind of act as first resistance. If we break through that, you could see prices really start to decline faster. But ultimately, I think right now we're still in no man's land waiting for that catalyst moment, that what-if moment that maybe we thought was going to come from FOMC, or maybe we'll get it with Powell's town hall meeting later this week. I think ultimately it comes down the road in March when we hear from the folks between the UK and the EU and how they arrange this Brexit deal. But ultimately right now the bond market still remains very, very much in flux and in no man's land. And if you look at market volatility, it isn't telling you that there's uncertainty or fear being priced into the market. Yeah, volatility is not going down, which ultimately in the bond market means it's positive for vol. But it's not going up either, and we're kind of just trading sideways. And I would guess that given the 10 basis point move in 2 days, or in 2 sessions, I should say, you would have really started to see things maybe get a little bit anxious. Maybe even if it's a trade that you're looking to anticipate, you would see the market look to race it. We're not seeing that. So the bond market very tempered here, low volatility, still in the range. However, starting to test the ends of those range, the extreme ends of those range quite frequently, and it looks to me like we're going to be testing the highs before too long. So right now, very mixed volatility signals, although yields are creeping higher. And what do we have ahead? Well, we've got earnings, and they've been doing well, and they've been taking center stage with China on a holiday. Likewise, we have the State of the Union, the delayed State of the Union. That's not really going to have an adverse effect or effect on the bond market per se, but you never know. There could be some nuggets in there that we can take and grab onto. And lastly, we also have the Federal Reserve that we had last week. We're still feeding on that, and the non-farm payroll number. So the data right now, along with the Fed tug of war going on, looks like the data is winning. So the real in the moment present data is trumping what we saw heard from the Federal Reserve last week. And right now the bond market is still within the range. We look at that 260 to 280 range. We're right near the middle of that. So you can't really say that we're too far off base. However, given that we've been touching these extremes recently, it looks like the bond market may be on its way north of 275 for a spell before revisiting, unless of course a catalyst event occurs, in which case all bets are off. And it looks to me like there are more people that are holding their hand on the buy button than on the sell button, at least in case of emergency. But ultimately, I think all the dust settles and all becomes more clear at the end of March when we get this Brexit mess behind us, because whether or not it's more mess or less, at least we have some certainty and we have some foundation to build on. Right now, the market's still anticipating what ifs, and until we get past March 29th, those what ifs are going to remain, and the bond market will remain, I think, pretty much in this range, leaning towards lower yields.